Hi, everybody. Amy Knight here with you and Jennifer Taylor from E3 Wealth. Amy Knight with Knight CPA Group. We're going to give everybody a minute to get jumped into the webinar. So just sit tight and then we'll get going. And just to let everybody know, I have two dogs at the office. They're not currently in my office. Oh, I hear them out there. But they'll probably be coming in shortly. And then Jennifer has big dogs at her house. I'm at my office. Jennifer's at home today and her oldest is
virtual learning. He's a senior, and I told him that if the dogs start barking, but anybody else out there that has a teenager knows that their selective hearing is very fascinating. So if you see if I'm smiling very tight, you'll know why.
Well, let's get rolling. It looks like everybody jumping in has kind of slowed down. We are recording today's session. So I always send out a link. I always post all of my videos are on my YouTube channel, even those that I only send out to clients. That's like a new update or, hey, here's what I'm thinking about PPP taxability and things like that. So I always encourage everybody to subscribe to the Knight CPA Group, not the Knight CPA Group's YouTube channel. I say that because the group that developed our website kept putting the Knight CPA Group on everything. It took us a while to get the taken off. But if you subscribe on YouTube, it helps me be able to do more things on YouTube. But besides that, you'll get an alert or a notification, especially if you've got it on your phone, that just says, hey, Knight CPA Group posted something new. It's not going to be a bunch of junk or spam because I don't post every week, sometimes 2 or 3 times a week, but sometimes not at all. This is going to be the first of my webcast series. I'm kind of I try to think of a catchy little phrase for it, but the only thing we've come up with is Wednesday Webcast. We're not going to do it weekly, but I'm thinking the first Wednesday of every month. So whatever the topic is, that's what we're going to discuss, whatever's kind of either relevant at that time or in the news, or, I kind of like fun stuff like, what books am I reading? Currently, I'm reading Green Lights by Matthew McConaughey. And I would say, if you're going to read it, I would put down the book and get it on Audible or some other audio version because he reads it. And I'm not even like a huge McConaughey fan. I am an OU Sooner. That's kind of a conflict right there. But he does an amazing job. And I just don't think me reading it would be the same. So we'll cover different things. I want the format to be like a podcast, but I just like to be able to talk to people and people be able to see me. I don't know why. I just like the video. I feel a much bigger connection with the video, even though I can't see all of you all. So we will do question and answer. We don't have slides. I don't even have, and I will for next time, I don't even have like here's our contact info. We'll get that. I'll send it out in the follow-up email. So we will have a follow-up email that has contact info and also a link to the video recording if you want to share it with anybody. There's a chat panel, but there's a Q&A panel, which is way better. So if you're on Zoom, you do have to kind of hover down along that bottom bar and it'll pop up. It's hidden unless you kind of hover over it, but it says Q&A. I'm going to open that now so I can kind of monitor that and see what pops up. We are going to just free flow it and it be a conversation. And so just to jump into it, what I'm hoping to cover here. So this went out to my audience, and my audience is really home health, hospice, nursing home, assisted living, that kind of field. And so what we are experiencing with our client base and what I'm hearing across the industry as a whole is that Medicare, HHS has doled out a lot of money. We had COVID, right? We have the COVID pandemic. We've got the PPP loans that went out. Most of our clients all received those. We also then started getting all this money from HHS with that provider relief fund. Phase 3 is currently going on right now for the application phase of it. We still keep getting inquiries about applying. And if you're going to apply, you need to apply by Friday. You've got to start it and get your TIN verification started by Friday, and then you're in the deadline. And so, but what's happening as a result of that is you guys are providing healthcare services, which hasn't dropped off drastically. We've witnessed a much bigger drop off in the PAS, provider care services arena. That has dropped off more. Hospice took a hit in the beginning, but I feel like they're kind of coming back on and everything's kind of ramping back up there. But what we are hearing, the common narrative that we're hearing is that we kind of have a lot of money left over. We got PPP loan that covered payroll for 8, 10, 12 weeks. And now we've got all this HHS money to cover all the additional that we've paid for PPE and then some. I don't even know if we can spend it all. And so what about all of our regular revenue? Because the most we've really seen is about, and if you have more than this, it's not a judgment, but we've seen about a 25% decrease in business for a month or two, and then it's kind of started ticking back up. And also we're here in Texas, and we have clients all over, but what I saw in Texas was that hit came a little bit later. So it came more in like not April, May, but really kind of June and July. The hit to cash flow, okay? Because if you think about how your cash flow is, it's delayed anyways. So that makes sense. So what do you want to do with this extra money? What should you do? How do you position yourself? What Jennifer and I were saying is, and I need to get back to some proper introductions for everybody that joined after I said that. But what's the best thing to do with this excess cash that you have? So that's kind of what we want to talk about. I want to give some practical financial management thoughts. And then I want to bring Jennifer in to give more along the like financial advisory kind of thoughts of like investing and what you can do with that money, in addition to paying down payables and debt and the normal stuff, right? So again, if you missed my introduction, I am Amy Knight with Knight CPA Group. We're a CPA firm located out of Austin, Texas. We serve nationally home care, hospice, home health, nursing homes, assisted living. We only serve those industries. So we're exclusive. We're experts in the field and have been for a long time. We celebrated 18 years this year, so we've been around for a little while. And then with me today, I've got Jennifer Taylor. And if you know me as Amy Taylor, there is no relationship. And then one of her partners' name is Terry Taylor. And so I was Amy Taylor when we met, and I was like, oh, it's just meant to be. But no relationship with any of them. So Jennifer works with E3 Wealth. She's a partner at E3 Wealth, and E3 Wealth is my personal wealth management team, as well as who I recommend and refer to any of our clients and anybody that asks me. And a couple of things that I want to set the stage for is that E3 Wealth, I think you can correct me, Jennifer, but their slogan is think differently, right? Okay. Yeah. Here's how they spoke to me. First of all, they walked into my office, total cold call with fudge, homemade fudge from down the street in Bastrop. And Terry had his business card was a poker chip. I happened to be walking through the front of the office when they came in. We had an English bulldog. They went crazy over the bulldog. And he gives me his poker chip. I was like, dude, this is great. Thank you, Eddie. Eddie says I look beautiful. I just saw that over there. I don't know. Maybe he was talking to Jennifer. Or it's both. We'll go with both. Okay, I'm sorry. Anyways, they had me with the poker chip, right? I am not.
Do you remember what the poker chip said?
No, but I still have it.
It said, don't gamble with your finances.
Okay.
Actually, slogan.
I don't like, it's really Brandis saying that. That sounds a little bit more like Brandis, not Eddie, but anyways, okay. I am not a typical CPA. Those of you that work with me, those of you that hear me speak, I think you get that sense. I really try to break things down into layman's terms, and I try to be not a CPA as much as possible. It's like my life's mission, and this is very serious. It's written down. My personal vision and mission is to shatter the stereotype of CPAs. I'm working on it. Okay. That being said, they do think different. They don't say, "Oh, you've got $50,000. Let's put it in the stock market. Let's put it in retirement funds." And that was what I wanted for me personally, was somebody that would listen to, like, what are my goals? They never once gave me any kind of advice until they said, "Well, what are your goals?" Like, and my goal is to retire before retirement age. So why do I want all my money into investment fund that I can't get to until retirement age? And so that's just why we're just a good fit. I like him. I love how they just sit down with everybody and say, what are your goals first? Because that's going to drive how we guide you. And so that just kind of lays the stage of, what we're thinking here. Again, this is our first webcast. It's not my first webinar, but normally, I have not a script, but I at least have a PowerPoint that I'm following. And those of you that watch me know I'm not very good at following that anyways. So we're just going to free flow through it. And I'll probably take control the first half and then turn it over, because I want to kind of cover some basics, right? So I'm working with a lot of people across the spectrum. And so let's say you're in the position where it's like, hey, I've got a lot of money left over. First thing I want to say is, don't feel dirty about that. And I know that kind of sounds silly, but some people feel very, very guilty. Let's not feel guilty about it. What I want, and because I don't want it to be misconstrued of, oh my God, we've profited off of the government. Let's take this money and go buy a new Mercedes. It's not what I'm saying. I think somebody already got arrested for that up in Dallas, so it's probably not a good idea. I think he bought a boat and a Bentley or something very extreme. But anyways, and I don't think he was in home care, by the way. That was a PPP loan. But I don't think you should feel guilty, right? Let's take this opportunity, see it as an opportunity to put yourself and your agency in a better place, a better position than you were going into this. And I just really hesitate to say this. Everything happens for a reason. And so try to find the silver lining. If you're in home health, this helped you through PDGM. So Jennifer, there was a large transition in payment structure on home health from PPS to PDGM. And it's not that PDGM is completely negative. It kind of depends on how your patient mix is and how your services are. But if you're kind of average and you're not like really heavy therapy or something, if you're kind of average, the problem was there was a hump to get over, and it dealt with billing and cash flow. And so people hadn't really prepared for that hump, and that hump hurt. And banks don't like to lend to Medicare providers. Well, this kind of came in. It's a little bit late. It could have been a month earlier. But the cash flow, honestly, the way it worked out, I think a lot of providers did not feel PDGM as bad as they would have. Once you get over that hump, I actually like that it's, instead of being a 60-day payment cycle, now it's a 30-day payment cycle, and that seems to flow a little bit better. So don't feel dirty about this. Let's put yourself in a better position than you were going in. And that's where I want to start. Going into this, I know I had a lot of providers that were kind of, if you think about it in personal terms, paycheck to paycheck. They were making ends meet, but not a whole lot. Now, I did have some providers that were making steady margins, and that's great. I'm still trying to find that magic elixir of those that are doing really well to those that struggle. I have a couple of thoughts. They're kind of touchy-feely thoughts. I think it's a lot about the energy that's being put out and where your focus is. And so that's probably talk for another day. But And so they might have to delay some payables. So my first point is, because I can talk forever and I need to keep an eye on the clock. First thing is, to me, there's this mix between debt and payables. If your payables are current, you're probably in good shape. Then tackle that debt first. Fortunately, in my client base, a lot of our clients don't have a lot of debt. Honestly, because banks don't really lend to them, which is not a good thing, but it's reality. But if you do have debt, especially if it's at a 5+ interest rate, my point is you pay that down. Second would be payables. Tackle your payables. Try to get over that hump of payables to where you can pay them on time or even as they come in. I mean, that's not the perfect. To me, it's easier because at the size that we are and the clients we work with, which we work with anybody from startup through, we've got clients that go to 10 million. Our sweet spot of the bulk are probably 2 to 8 million. Okay. That's where we're at. When you're at 20 million, you're running your payables on 30, 60-day terms, right? And that's normal. I get it. But you have systems to manage that. When you're smaller, managing that becomes a little bit more difficult. And it's like, hey, I've got payables. I'm paying payables every Friday, whatever's due or whatever's in there, I'm just paying, right? Find yourself a sweet spot on payables. And then really kind of think about because you got HHS provider relief funds, stock up on PPE, do that before year end. I hear the chihuahua outside my door with a little, she wants in. Nobody hears her yet. They'll get her. Provider relief funds, use that for some PPE, stockpile that. Start stockpiling some cash. What if this hits again, harder, second time, third time? Make sure you've got that cash that you can kind of sustain it. We don't know. Thank you. We don't know if there's going to be another round of PPP loans. We don't know what other, especially with kind of where the election is right now, nobody knows. We don't know what's going to be coming, right? So really kind of stockpile that cash. And then we've got some providers that are like, look, I got enough cash in the bank to carry us. We were aggressive. My nurses, my team was aggressive, and we really trained our patients that we're not going to get you sick. Let us in your homes. We're going to take care of you. And then went after the ones that were sick, and they really sustained and have done well, and they have a lot of cash left. So then there's that question, like, what do we do next? And I don't have my notes in front of me, but the one I forgot, prepare for taxes. We probably should touch on taxes. And there's another one I missed because I did just turn to my notes. Invest in your business. And this is one thing that E3 said to me that was just like an aha, yes, somebody gets it. They say the best place to invest your money is in your own business. So anytime I wanted to take money, even if I already had it invested and I wanted to withdraw it out of funds or whatever, and say, well, you know what, I want to hire a new marketing team. I want to get, whatever I want to do to grow my business. They're like, that, you'll get the best return on that. So now when I want to take it out to buy a boat, they kind of give me a side eye, but I work hard and I need that boat.
We are not life coaches. Don't even put that on. We do not give you side eyes at all. In fact, if anything, you take us out on the boat so that we encourage you to buy more boats. No, I think what you touched on is really important. And that is any financial advisor that you work with. Financial advisors often get a bad name because we want to take over all your assets, and find places for them that a lot of times have barriers for people to get to. And I think for the average American, barriers are a good thing. When you're dealing with business owners and entrepreneurs, those set of rules have to be thrown out. Because one thing we will say, if you want to talk rate of return, you will probably get a higher rate of return on putting money back into your business than any type of investment an advisor can offer. And so liquidity is huge. Now, the problem is for people that are sitting heavy in cash in a bank, we all know right now you're not earning anything. And so finding better ways to stay liquid and have more earning power is important. And that's something that you should be discussing with your financial advisor. A lot of times, financial advisors don't want to talk about cash or things in the bank because we don't get paid off of what you have in a bank. However, for most people, they get the idea they need 3 to 6 months of emergency funds. Well, let's take this pandemic situation we had. People were very exposed on how illiquid they are. And not every business got PPPs, and not everybody was set up for that. And not every business, I think in every industry, some people were successful and positioned themselves for success, others did not. And this was a time that was very telling. And so how do we learn from that moving forward, I think is what you're getting at, and making sure that, okay, now that you have this money, now you're in a position of power. How do we stay in that position moving forward?
Exactly. And I'm real careful, not judging. I want to define liquidity for anybody that's listening. That's like, I know that term. That just means you've got access to it, right? Like, how liquid is it? And so I talked to somebody.
The stock market is liquid. Okay, so the stock market is liquid. Now, the way we base everything is we talk about everybody wants three things. They want safety, they want liquidity, and growth. There is nothing out there that gives you that, because if you put your money in the bank, you have safety, you have liquidity, access, you don't have growth at all. In fact, some people might even say you're basically losing money safely because you're not keeping up with inflation. Whereas if you put it in the market, you have liquidity because you can get in and out, growth potential, but now you're sacrificing some safety as well. So there's no perfect investment out there. There are pros and cons to anything that you do. And when you sit down with an advisor and you discuss what your goals are, then you have to find what investments best suit your goals.
Yep. And I remember we met for the very first time. I'm married now. I was not married then. And I had my goals. My goal, just so everybody knows that my goal is to someday, and it will happen, live on the beach in the Caribbean. Like, I want to live there. Maybe it's only 6 months a year. I want to live there because my husband has not bought into that vision 100%, although he's getting there step by step. And so it was 3 years later, we were meeting, just touching base and catching up. And they were like, okay, so how much closer are we to living on the beach? I was like, oh, wow, they really remember that. Not only did they remember it, they took it serious, because I'm very serious, y'all. So anyways, I want to make sure that everybody knows that there are people out there that can provide that service to you. Just like what the pandemic has done for me, I knew you guys needed all this information, all this education. I was not scared to get out there and tell you on Friday, as of today, here's what I know, here's what they're saying, and we're solid with this. And then Monday, it was already changed. I mean, it happened over and over. And a lot of CPAs would not do that because they're very, very conservative. And if they're with a big firm, I get it, because they all have lawyers and they think they're going to be sued and all that stuff. And I just trust that people believe I have their best interest in mind, and that they're not going to sue me because I said something was wrong, but on that day it was right, and so that's one thing we have to be careful about, especially today, and today we won't, I do have some couple questions I want to get to, and we are offering general advice. Nobody has hired us for any of this. So we're not, so there's our disclaimer that you have not engaged us. So we're not advising you specifically on your specific situation because we don't know it yet. Right. But in that exposure for the pandemic, I've had a lot of feedback. There are a lot of providers that didn't know there was somebody like me that only did home health and wasn't a big firm like BKD or Mueller Post, which they do home health and hospice, but they do a lot of other things too. And they're big firms. So this is part of this, is just to bring your awareness that there are financial advisors besides Edward Jones and Merrill Lynch and, some of the big house names that, that do the standard, we want to put your money in the stock market. Because I get that a lot. They're like, oh, I don't want to invest in the stock market. That's okay. That my team does a lot more than that.
Well, and I think that's where we are independent, which makes a difference. And we can go into that much deeper. It means that if you were to go to an Edward Jones, Merrill Lynch, they have proprietary products. They have products that they have to sell. We are independent, meaning that we can pretty much pick and choose in order to be what's best for the client. The other thing that's different is that we like things that don't correlate to the stock market. This goes back to, we think stocks, bonds, cash are great, but that's not the only thing. And we always say it's not that we think outside the box. There's a much bigger toolbox out there than people realize. And this goes back to the conversation of taxes. So one thing that's different for us with you, Amy, the questions, the things you're getting from people are, how am I going to save taxes this year? I need to save this year. I need to save this year. It's very focused on this year. When we meet with clients, we can absolutely help. And we're going to touch on some things for higher net worth, high income earners, tax saving strategies. We talk about, yes, let's look at how we can save, but let's also discuss, does it make sense to put off paying tax on a known rate versus an unknown rate? Does it make sense to kick the can down the road per se? We have this year alone, the amount of stimulus, the dollars that have been put out into the economy. I'm not getting into politics, but I will tell you there's bad decisions on both sides of the aisle when it comes to the economic status, social security strains, all of the different things that you just have. At some point, the tax rates are going to have to change, and we can't imagine them getting any lower. And you're also going to see things like estate tax, that's got a bullseye on it. You're going to see things like capital gains tax, that's got a bullseye on it, different things. And so we always want to look at, okay, while saving taxes this year is important, let's also look at getting you positioned that you have more balance. You should look at your money in 3 ways: taxable, tax deferred, tax free, tax exempt. How do we get you balanced so that if 10, 15, 20 years down the road, your tax rate is 50, 60%, which, folks, let's remember, look way back in the day when there was such a thing as a 90% tax rate. Those things can happen. How do we position you so that you are not subject to the government's rules? And this is a year in particular that if there isn't a better reminder that you should not be stocking every dollar you have into 401ks, SEP IRAs, qualified, what we call qualified plans. Okay, let's take this year. It took a pandemic for the government to decide that you could have access to your money, okay? So as a business owner, that's a problem. If you're having to raid 401ks, IRAs, SEPs, et cetera, in order to get access to your own money. The other thing is, if you're wanting to retire, and this is a conversation we have with a lot of business owners, they don't want to own their business until they're 60. A lot of them target that 50, 55 timeframe. Well, if you're putting money into plans you can't touch until you're 60, what's your plan for that 5-year gap? Have you thought that through? Have you discussed that with an advisor? Those are things that are important. And we're about control. Especially for a business owner, for an entrepreneur, you need to have control. Yes, you have to pay tax, but man, what about if you get to decide when and at what rate? And that goes back to the idea of paying on the known versus the unknown, and also saving in the best way for you, because you might sit down and a 401k, a SEP, a defined benefit plan, there's pros and cons to all of that, but simply because that's what you were told to do, does it make sense for what you're trying to accomplish 5, 10 years from now? Those are the things that, while I get it, paying tax hurts, it stinks, nobody wants to do it in this year, sometimes you've got to look at the numbers and where your goals are and what you're trying to accomplish.
Yeah, and that leads into, let's go to this first question here. Do we have to pay taxes on HHS or PPP money? Yes, you do. At this time, for sure, let's talk about HHS provider relief funds, because that one's far easier to deal with. It's 100% taxable. The way that's going to work is, you've got this chunk of money, and you have to, the way I've been saying it, you have to justify withdrawing that money from that. You should have it in a special account, separate account. And when you've spent the money appropriately and then you reimburse yourself out of that fund, that is when you recognize that income, and that's going to be taxable income. So let's just say you had $100,000 from HHS provider relief funds. By the end of the year, you've spent, used, qualified for, justified $80,000, then you're going to have $80,000 recognized as income on your P&L, on your profit loss statement, taxable, recognized as taxable income on your tax return for 2020. The part that you don't spend by 12/31 carries into 2020. Well, you don't spend by the end of this year, carries into next year. Next year, you only have until June 30th to spend it all. When you spend it, that's when the income will be recognized on that. So those of you that are not using a tax preparer that knows how to do that, understands that money, and they have you on a cash basis. Cash basis brings an interesting question into play there. I still think even on cash basis, we won't pay tax on that when it's recognized, when it's deposited, because you may have to pay it back. If you don't spend it all, you have to pay that back. But what you spend, you do have to pay taxes. I am recommending in our industry, you spend as much of that as you can this year. Okay, that's a whole nother webinar. I actually just did one for TAC, but they charged for it. I will be doing another one in the next probably 30 days to just kind of get everybody prepared for that for year end. So we'll look for that. On the PPP side, right now it is taxable. The amount forgiven is what's going to be taxable. I'm saying it in a very loose manner. Really, what is tax? The way it works is the expenses paid with tax-free dollars, PPP loan, are not deductible. Okay, so now we have this dilemma of we've got to file taxes for 2020. Expenses are all in 2020, but we're not going to file that till next year, and we're not going to get forgiveness until next year, most likely. IRS has come down hard on that, and they are stating if you expect forgiveness, you cannot deduct those expenses this year. And kind of to play off of what Jennifer's saying, and my philosophy also is, if you spent according to the rules and you know that you're going to get forgiveness, I recommend filing the application now if you've been given the link to do so. This is a personal preference. If you want to just get it over with, then by all means, just get it over with. If it's less than 150,000, feel free to hang on to that, because they still have a big push to do a blanket forgiveness on those. What is not just a personal preference is I would wait to file this year's tax return until you know what happens with your forgiveness. So literally, you can wait until September 15th. And I hate that. We do not like doing taxes in summertime. Again, I want to be on the lake. But this coming year, we're going to tell you to wait, because what you don't want to do is file your tax return before you know, and then have to amend 2020. But again, with what Jennifer said, in my personal opinion is, I would rather pay the tax on my PPP loan this year, because I know what the tax rates are, and I don't know what they're going to be next year. I 99% feel they will not be lower next year. I want to say I 100% know they're not going to be lower next year. So that's kind of my 2 cents on that. So to answer that question, yes, it is taxable. And how do you get away from paying the high tax? That's what we're going to kind of talk about. Let me touch on throw out a few quick ideas on how to reinvest in your business, because that's the next question. She asked, if I buy a vehicle for our employees to reduce the cost of mileage, does that count? It absolutely does. Now there gets into some tax rules. If you buy a $30,000 Corolla, well, that's an expensive Corolla, whatever. If you buy like a Corolla, the whole amount is not deductible in year one. There's Section 179 limits. There are a lot of things that come into play. If you lease a bunch of cars, that's a little bit more deductible, but that doesn't work well for a home care agency because you put way too many miles on it. So buying a vehicle, depending on what kind of vehicle it is, will reduce your overhead by lowering, it's not overhead, reduce your cost by lowering, saving money on mileage. But it may not save money on taxes because you can't just write off the whole entire car this year. Whereas mileage, you get to write that off. But you'll probably come in a cash positive position, but your tax might go up a little bit, but not as much as your costs go down, if that makes sense. Costs are going to go down for mileage. Owning the car is cheaper than paying the mileage, but it's not all deductible. So your tax might go up a little bit, but you probably would have a cost savings. That is a very general discussion and general statement just for everybody. And again, everybody's situation will be unique. A couple of other ways to reinvest in your business. If you are not yet paperless, heavily consider making that move. If you're still on patchwork EMR software, or you're on a low-end software because you didn't want to, and when I say low-end and high-end, I'm not talking home care, home base, and no knock on them. They're great, but they are very high-end software. They're for very large providers. They're very expensive. But if you're in that even startup to $8-10 million, you should be on something like Access, Kinzer, CanTime for the home care side, or private duty, Alaya Care. You need to have a full, complete EMR, right? So if you haven't invested in something like that, if you haven't invested in point of care, that's first step towards paperless. Those are things I'm talking about reinvesting in your business. Invest in software, invest in technology, invest in systems and operating systems, invest in, maybe an on-call service provider, like a nurse triage, like NurseLine or something like that. Those are the things I'm looking at. So Jennifer, can you see the questions, the Q&As?
I can see the one on the Bitcoin. Is that what you wanted to address? Okay, so what I would say, so the question is for Bitcoin and cryptocurrencies, they're very liquid. Do you advise home care agencies venturing into that area, and how can allocate funds into that from a business? I'm just going to specifically address, do we recommend that for liquidity? So I don't know enough about your situation to say yes or no, but this is what I will tell you. Bitcoin and cryptocurrencies are still an investment, so they still carry risk. So if we're sitting there talking about your emergency opportunity fund, right? Because let's face it, as a business owner, you're not just worried about the rainy day. You're considering, well, what if this home health agency becomes available as a sale, and I have the opportunity to buy it and invest in my business. So, and if you're now in Bitcoin cryptocurrency that has devalued and it's worth a lot less than when you bought in, well, now you have a problem. So you need to remember that an investment like that carries risk, and what's the purpose of the dollars. So if those dollars are emergency opportunity, then I would look at a much safer type of investment than that. That's not to say that maybe there isn't a place for that, but it's no different than building a house. You got to worry about the foundation, the walls, making sure the structure is solid before you start going crazy on the decorations and the high-end appliances. Right? Which we all like shiny things.
Yes, and I just pulled up my Coinbase. I did it just for fun, absolutely against their advice. And I remember sitting in their office, and Joe was like, well, I don't think it's that easy to actually get your money back. It's I cashed some out, and it worked. But I put enough in to just have fun, and it actually looks okay today. But I mean, I took a huge hit because, of course, I bought when it was really popular and high and all that stuff. But I like that advice. I too think it is way too risky. It's like a fad. That would not be my first thing. Again, I'm not a financial advisor, nor do I want to be. That's a very common path for CPAs to take. I would not put in more than you're willing to lose, because it's like the change of the wind with that stuff. It fluctuates a lot.
Right. And that again goes back to the purpose of those dollars. Like when we have clients that literally are discussing, I cannot stomach the ups and downs and the da da da, and we go aggressive, equity portfolio. We're not listening.
Yeah.
We're not listening. And because don't buy into oh, I have a long time horizon, so I need to be aggressive. I need to be. Do you need to be, or is that what they're telling you? Because there are some 30-year-olds who can't stomach it and want to make sure that they see things, they just see things differently. That's more important than talking about rate of return. Real estate is a big one. Okay. So for a lot of people and how to structure, et cetera. But real estate is something that doesn't correlate to the market. And a lot of advisors won't tell you to invest in real estate because that's not something that we can get compensated on. Now, what I will tell you is there are ways to buy and sell real estate that if you do tire of owning a building and you want to get out, like say you own some buildings, you don't want to be a landlord anymore. You can 1031 into things called DSTs, which are Delaware Statutory Trusts, that will then basically give you mailbox money, and they pay you a stated rate of return. It's the same idea of swap till you drop. And so those are ways that you can invest in real estate without having to actually go out and identify a property, because a lot of people on here probably own their building or are looking at buying buildings. And at some point, they're not going to want to do that anymore. And they feel like they're stuck. Well, you're not stuck. You have other options than having to physically go out and identify properties and buying those and being the landlord.
And 1031 is some kind of exchange.
It's a tax. That's a tax code. That's a tax law. It's a way to roll your money in with, and you avoid a lot of money on tax, and if you were to die down the road, the person that inherits that gets that step up in basis on that investment. It doesn't just have to be on the actual physical property. It'd be no different than if someone passed away, and if I was older and my adult children inherited my beach house type of thing. Well, they don't inherit it at the price that I paid for it. They get what's called a step up in basis. And so if I bought it at $500,000 and when I die, it's $2 million, their new basis is $2 million. So those are things that a 1031 provides. Again, without having to, because most people don't work, they're not going to work forever. They don't want to work forever. And even people who really enjoy owning properties at some point kind of get tired of it. And you get a bad renter, or you get a crappy property that has a lot of problems, and you no longer want to have to deal with the day-to-day, and you decide to sell. Most of the time, people 1031 into another property, meaning they roll those funds into the next property that they've identified. Well, that defeats the purpose if you don't want to be a landlord. So there are things called DSTs, Delaware Statutory Trusts, that are investments, and you can roll your money into those. It fits the same 1031 rules, and then you get just a dividend monthly payment, just like you would if you were collecting, but now you're no longer having to pay for expenses and things like that. You don't actually have to be the landlord.
And mailbox money is good, y'all. I do want to answer one. So we talked about investing in like expanding service lines and buying other agencies or other providers. I want to be very careful. Your HHS Provider Relief Fund. So Jennifer, the way they define this, you can use that money to prevent, prepare for, or respond to coronavirus. Then they went into some details that said, something like including expanding healthcare delivery. I think that's a very gray area. My gut professional opinion is they are not going to allow you to take HHS funds and say, hey, I bought this struggling provider and claim that as a legitimate expense. I don't think they're going to allow it. I think what they mean about expanding patient care, I think they mean going into another area, reaching further, but I don't even think they're going to allow you to like start a new provider. That to me just seems like too much of a stretch. If you can't spend it otherwise, that's a Hail Mary, by all means, go for it, right? And you're going to do that anyways. Turn it in, see what they say. They may not. I just feel like there's going to be a lot of oversight, a lot of audit. Cut to the chase. I think there's going to be a lot of review and audit of this money, depending on how much. If you received over $750,000, not including PPP, but HHS money, you're required and subject to a single audit. Most of you probably didn't get that much unless you're a nursing home and you keep getting money. You might start getting to that point, but even under that amount, I think there's going to be a lot of audit. I don't think they're going to audit everybody. I think there's going to be some scrutinization. So I would be careful of that. So we are not saying that investing in your business qualifies for HHS expense, but let HHS cover all that other stuff that it can, and you still have a chunk of change left over. So what we're talking about now is going to be things that it's your excess operating net income, because you had other cash to pay for your regular expenses.
I want to answer the question on the best return on cash and checking. So the question, best return on cash and checking, or would we recommend kind of a annuity, a CD? They have cash sitting in a checking savings account, not really earning interest or minimal interest. So the first question I would ask would be, okay, what's that money for? Why do you have that sitting in the bank? Are you in a situation where you're at your comfort zone, but you're not happy with what you're getting? Are you in a situation where you are sitting really heavy on cash to where you're uncomfortable? You want that money working for you in a better way. And then the next question would be, okay, how much access do you need? Because one thing people have to understand, a lot of times when there's a pro and a con to an investment. So if you're talking about, one thing you mentioned was a CD. Honestly, right now, CDs are not paying what they used to be. Like back when your mortgage interests were 8, 9, 10%, CDs were paying about the same. So now we're looking at CDs 1, 2%, so really, is it that much for a 12-month lockup type of thing? You mentioned an annuity. So if it's an annuity, there's nothing wrong with an annuity if you understand what it's for. A lot of times we look at annuities to provide income down the road. There's appropriate and inappropriate application to an investment. As I say, we will always tell you, it's not always about the investment itself. It's about the proper usage. For example, if you're 25 years old and you're telling me that you want money for a house, and I recommend that you put money in a Roth IRA or an IRA, there's nothing wrong with a Roth or an IRA, but for the purpose, for what you want it, I just did you a disservice because I'm telling you to put it in jail until you're 60. So that doesn't make sense. So there's positives about annuities, but there's also a downside. A lot of times annuities have what they call surrenders. You have limited access early on. So it might not be the best place for what you're trying to accomplish. If you're going to need that money in a year or two, sometimes you might just say, my need for the money is greater than my need for higher interest. So you've got to weigh which is more important. We like, and there's a term that you can look at. One of the things that we like for cash is what we call specially designed life insurance contract, specially designed insurance contract, non-sexy, whole life. Look up privatized banking, bank on yourself. And I want to stress, we don't say that you should do this over that. We like it as a part of your plan. When people come to us, we like annuities. We like insurance products. We like the market. We like managed money. We like structured notes. We like CDs. That's the thing about having a plan. But each part of your plan does something different. 401ks, SEP IRAs, they serve a purpose as a part of your plan. So if you look at those, again, there's a con. You have low early liquidity, meaning it takes time. If you put $100,000 in your bank, boom, you see it, you get online, you see it day one. You have access, $100,000 day one. If you do that inside of a whole life specially designed insurance contract, you might see $60,000 to $70,000 of access in day one, but you're getting higher potential for a dividend. So again, what's more important to you? Is having full access the most important thing? Well, then you might have to sacrifice the growth. If it's kind of a set it and forget it, I don't need it, then we can talk about sacrificing liquidity. It just depends on what's the more pressing need for the money.
Jennifer, so on an annuity, is there any liquidity to that now in a year? Are there short annuities?
So there are things called SPIAs, which are single premium immediate annuities. There are things like that. But even then, usually if you set up an annuity appropriately, there's still going to be a limit on what you should take or how you take it. A lot of times annuities have what they call, like I said, surrender charges, like if you wanted to take your full amount, but they oftentimes have a free withdrawal amount that you can take each year. And it also depends on if it's set up, in a 59, if it falls under that 59 and a half, then you become subject to both early withdrawal rules and taxation. So structure is important.
And so to touch on and try to kind of put it in my layman terms, that specially designed insurance contract, that's my favorite. That's literally, and you guys know, if you ask me, I'll share more than I really should, but I really do. I am a boat person. I'm a water baby for sure. And that's where I took my money to buy a boat, because I've been funding this insurance contract. It provides me a life insurance, right? So I've got a life insurance policy, but the way it works is I fund monthly. And so I just, that's like my savings account. And then there are other ones I have clients that have done it where they had a chunk of change. It's like kind of like in what I'm picturing this situation. I got a chunk of change. I need to put it somewhere. And so for mine, it took a few years, and then I could withdraw a little bit. And then it got now where I have a little bank. It's this privatized banking. And here's the cool part about it. So, and I'm using plain numbers. I don't know what the numbers are now, but like my numbers are whatever my cash value is, it's sitting there. It is earning, I think, 6.6%. Just flat, even, nothing exciting. However, when I borrow money from myself, I'm being charged an interest rate of 4.6%, make it even, right? 2% difference. So I'm paying 4.6% interest. However, so say I have $100,000, I took $30,000 out for a boat. That $30,000 I withdrew and I used to buy a boat is still earning that 6.6%. I'm paying 4.6% interest on it. So I'm still earning a 2% interest. So I'm still making money. The better use of that money, and this is where they try to guide you, is take what if my client that's asking these questions without calling you by name, what if you take out that money to buy that other agency? And so now you're still earning 2% on it, right? Because you borrowed it from yourself. Yeah, it takes a little while for that cash to grow. When I say a little while, a few years, depends on how you do it. But not only that, but now you've invested in another business that then is going to start generating 10, 12% interest. I mean, wow, and then you pay yourself back.
And we have some people that build those up specifically to use for tax strategies, to pay their taxes, where they do, and again, higher end tax strategies. I'm not talking about the SEPs, the 401ks, et cetera. We're talking about higher end tax strategies. They use it, they ladder it that way. Some things to note about, and again, I'm not saying go buy a whole life policy. That's not what I'm saying, because you have to be, the reason that whole life gets a bad rep is people, number one, convince you that it's better than all these other things. This goes back to, we never say, do this, not that. We say, do this and do that, because a lot of times if you're building up your bank, you can use it for other things. But money inside, this is important in the state of Texas, money inside of cash value whole life products are asset protected, meaning they're lawsuit protected. Any cash you have sitting in your bank, if you were to be sued, that's not the case. So that is important. When people go really, really cash heavy, you've got to make sure that you're not exposed to lawsuits and things like that. Specially designed, the reason that we use that term is because most people, when they go out and buy an insurance product, they do so why? For a death benefit. I have term on myself. It's cheap. I have 3 kids. The idea is that when I wanted to at least cover the time until they're out of college, et cetera, cheap monthly, at the end of the 30-year term, you get nothing. The idea behind whole life is you're building cash value, and it goes on as long as you live. And if you utilize it correctly, again, this is another area we're different, where we think we're experts. We're very big on utilization and how you utilize your cash. Emergencies, opportunities, emergencies, opportunities. Right now, we're in a super low interest rate environment. We aren't always going to be that way. Borrowing money is not always going to be cheap like it is. And so if you can be in control and not the bank, that's the goal. And so that's why we like to see these overfunded whole life policies that are designed not for death benefit. Yes, that's something that comes with it, but they're designed for cash value and utilization. Again, you can do research, you'll see why it's bad, why it's good. This goes back to understanding what your biggest needs are, and also working with someone who understands how to design them correctly so that you're getting the cash value and utilization that you can get.
And somebody's asking what company should they look at for the specialized whole life insurance contracting?
So companies, again, the companies that we use, because I would not go out and directly get involved with an insurance salesman.
Right.
Okay?
I was going to say, really get an advisor.
But we use dividend paying, not mutually owned. We don't want to deal with share and stockholders. We like the old schools. We like Guardian, Mass Mutual, Ohio, Lafayette are some of the ones that we like, because they don't answer to shareholders. So again, it's a different concept, and I cannot stress enough, I'm not sitting here telling people go out and buy a whole life policy. What I am saying is there's so many things out there that people just aren't aware of, and
yes.
The goal today is just to educate. And if you work with someone that can design it appropriately to fit your needs, then that's what you want to do. And we're not the only advisors out there that do that. But I will say this, one of our founding members, John Moriarty, wrote several books on specially designed insurance. I'm trying to, of course, off the top of my head, I should have written it down before. I'll think on this, I'll look up his books. But and they're very big on, again, we look at whole life, we look at that as the same as alternative investments, real estate, et cetera, things that go beyond stocks, bonds, and cash. Can you use the money inside those to buy stocks? I mean, shoot, March when everything, that was a huge buying opportunity for a lot of people. You can't always look at volatility as a bad thing. This goes back to what you're talking about and putting yourself in a position of power. Now that for the people that have really benefited from this pandemic, how do you, a year from now, find yourself in as good, if not better, of a position than you're in right now? How do you avoid, when things go south, finding yourself in a bad position again?
So I've got another question in here, but it really stumped me up because it's from Michelle Broll, which is my executive assistant. And I'm like, Michelle, did you just ask a question in our webinar? It's somebody that called in. They were having a hard time logging in. She sent them her link specifically, and it's fine. It's no big deal. But they said they hired some employees with the stimulus money. Are these legal expenses for stimulus funds? So this kind of goes back to my little world. Yes. However, I highly, highly recommend you set up a separate pay item. And so instead of them just having wages, they are COVID wages. It's something very specific, but it's very common. And a lot of people took existing people and repurposed them. But that's one of the things I've been kind of preaching in my webinars. If you've got somebody, especially if you hired them just because of COVID, specifically like, they called him COVID coordinator and PPE coordinator, but also like compliance. COVID compliance. I mean, that's a full-time job now for these guys. Jennifer, we think we have a lot of compliance. I've sat in and been part of webinars where it's been with the clinical side. And I'm like, oh my gosh, like there are really specific ways how they have to take their gear, put their gear on and take it off. It's called donning and doffing. And I had to go in. So I have sinus surgery tomorrow. So I will take any of the good vibes, source energy, healing, prayers, whatever, for as little pain as possible because I'm scared. But anyways, I had to go do a COVID test on Monday. And when I was there, a girl was there to get, and it was at like an urgent care clinic. And she was there. Was starting a new job. And yes, I'm nosy. I was just kind of hearing. And she was getting her N95 fitted. And I found that interesting. I mean, I'm just like slapping a mask on and I'm glad there's so much. It gave me a sense of comfort to know that there's so much compliance going on the clinical side. But so yes, to answer that question, I did skip one question that says, can we use our excess operating funds, not from any of the relief efforts, to expand services within home care, such as offering DME and also to use it to build their property? And I say yes, but I started answering that just kind of privately. For expanding care, offering DME, going into new areas, absolutely. I will say be careful. DME is a whole nother world, so please understand what you're getting into. As far as building a property, I want to be a little bit careful there. A lot of people think, I'm going to go build a property and that's going to be a big, I'm going to spend a lot of money and therefore save a lot of taxes. That's not true. Because the money you spend to build that property, you are investing it in an asset. Great investment, in my opinion, but it's not a tax deduction. So really what I would advise, you're going to take from your home care agency, you're going to withdraw distributions. Again, depends on how you're taxed, how you're set up, but you're going to need to withdraw that money from the company and do that either personally or in another company that owns the property. And so that's a whole nother animal. I think it's a great use of money, but that's a whole nother animal that we just don't even have time to go down that rabbit hole. That would probably be a good topic to cover at some point. But, and I'll be very honest, I told my staff this week, okay, not to get ahead of ourselves, but I might start looking for more property or for a piece of property to develop, because I think if I can meet my goals, we might need more space in 3 years. I might need roommates, Jennifer. I might need office partners.
Well, I'm gonna tell Joe, because I think we're looking for roommates in our new build. So you might have to come a little more south. But if MoPac, no. For you, that might be easier because remember now that MoPac and 45 dumps right in there. So.
Oh yeah. Oh, okay.
So one thing I wanted to say, when people are, I should have mentioned this kind of in the beginning. If you were serious, like if people are sitting here listening and anything that I've said sounds intriguing, I know that Amy's going to give our contact information and things like that. Having a call, a consultation, that's not going to cost you anything. There's no fees in kind of a discovery and seeing if we can help you, because we're not a fit for everybody. And we're okay saying that. But if, for example, the idea of a specially designed insurance contract is appealing, I would much rather that you reach out to us and really, truly, let's go deeper and understand that, than you just call an insurance agency, because selling an insurance product and in designing a plan are very different. So we'll get all the contact information out to you and all of that. But I just want to stress, our goal and our relationship with Amy is to add value for her to her clients. She trusts us, we trust her, and we want to make sure that people are educated. And so if nothing else, if we can at least have a call where you're fully educated, that's important. I do know, and I know that it's 11 and there's probably some people that are sitting here like, okay, so I've got all this money. I'm really probably going to pay a lot in taxes this year. What do we do?
Yeah. And I'm sorry, I told you we could talk forever. I usually book these for 90 minutes. We've not lost much participation, so we'll just keep going.
And that's why I keep thinking of, like, people are like, okay, so what do we talk about this? I want to make sure that we don't overlook. So there's a couple different things that, and this again goes back to the idea behind alternative investments. And these are things that you're not going to hear a lot about, because people need to understand the majority of Americans are talking about their tax return and what they're going to do with their tax return. There's a different conversation for those of us that are like, I owe a ton in tax. How do I lower that burden? How do I plan for that? And so that's why you don't hear as much, because there's probably a lot less of the people out there that need to take advantage of tax laws. And I would say that because people think that it's trying to be shady. That's not true at all. And I can't remember how many pages there are of tax code, but I can tell you less than 30 of those pages are about actual taxation. The remainder of tax law is about how to save people money and loopholes and different things. And so they're just not being taken advantage of. So there's one strategy, and again, I cannot say this enough from a compliance standpoint. I am by no means making this recommendation to people at all. I know nothing about the people on this call, on this plant. This is simply to know that there are things out there and available that just aren't being talked about. So we really are bullish and we like natural gas. And I'm pulling up my notes here because I want to make sure that as I'm saying this, in case there is somebody that's compliant, that they don't come back to me and say, wait a minute, you said. So we have done, we like natural gas, more preferable even to oil. We like some of their investments for tax strategies because they give you a large above the line deduction. So for example, we have, because you get what's called intangible drilling costs, and they give that as an above the line deduction. So let's say that somebody invested $250,000. They get a 37% of the dollars. So that creates about $74,000 in tax savings. And you're not just dumping it and then you give up, you're not using it anymore. You're hoping that this investment also produces about, we're hoping, a certain percentage of cash flow in the first 2 to 6 years. They're often front loaded so that you get a return of your money in those first 5 to 6 years in a royalty stream. And then it continues to pay out over the next 45 plus years or so, also in a royalty stream. So again, you're then paying tax on the dollars in smaller ways, and you're also doing them as it's being considered royalty income as opposed to employment income, or there's a lot, if I'm saying that correctly, and hopefully that's making sense. So then you're expecting it to produce about 3 to 7%. It's subject to natural gas prices, but again, they continue to pay out very well even when prices were lower. So that's something that a lot of people don't know about. But again, I'm talking about a $250,000 investment. So that's not the average American that we're discussing. This is for somebody that obviously we're talking to a different type of income earner. Because a lot of alternatives, what people have to understand, a lot of alternative investments fall into the accredited investor rules, meaning that you have higher income limits as well as higher asset limits. So the person that's struggling paycheck to paycheck and has $500 in the bank is not going to be considered an accredited investor. So that's one of the ones that we like. Another one that's interesting is what they call fee simple investments. Some people have heard of these as easement strategies, et cetera. The idea behind it is that a company takes a piece of property and instead of developing it into condos, high rises, selling it for all that it's worth, they decide to hold on to it, and either for a green strategy, meaning they're not going to develop, utilize it, or maybe they'll use it as a mining strategy or something like that. And then they turn around and make a donation, a charitable donation. And so you can get a deduction that way. Oftentimes those have AGI limits. You're only allowed to invest about 30% of your AGI. So again, these are higher end strategies that you really have to dig in, do the math, do the numbers. This isn't like okay, how much can I max out my SET, my 401, et cetera, this year? This is where we would sit, if you were to meet with us, we would sit down and say, if you did a $50,000, if you did $100,000 investment, this is what it would save you on taxes. This is how it would look like over the next 2, 5, 6, 10 years, et cetera. Does this make sense? Because at the end of the day, it might not make sense. The question oftentimes is, would you rather pay more money to the IRS or find ways, you might still have to part with the money, but ways to get it back slowly over time? Again, high-end strategies, they're not recommended for everybody, but they are available. And if you find yourself in a position where you've maxed out all the things and you're looking at an extremely high tax bill and you want to explore if there's a way to alleviate it, we can definitely help you explore that. And we do have better things available than just the standard everyday tools.
Yeah, and that's why they're my go-to, and that's why I have some of those. I don't have all of them, but anyways, so I think that's all. I mean, we're a little bit past the hour. I think we've had a really good discussion. We've had some great engaging questions. The last one, and I did answer it in the Q&A panel, but just to touch on it, they said, we've got this position. We hired just a COVID person. What if we had those same duties, but they were spread amongst other existing staff? That becomes harder because you've got to do a time study, which means a daily timesheet that shows your administrator did administrator duties in detail for these many hours. And then from this time to this time, they did temp checks. And this time to this time, they did donning and doffing training and this and that. And I just think it becomes harder to explain. But if you do that, again, give them a separate pay code for those wages. Picture this. End of the period, end of the year, you turn in a payroll report that shows wages, skilled, RN visits, LVN visits, COVID time. And I'm talking the summary, the total, not patient, not step by step, but the total. And you got your total wages. You're like, hey, these were COVID wages. That might be enough. But if the more you have to show them to justify it, the more likely it is to be scrutinized. So that's kind of my little answer on that. So with that, I think we'll wrap it up. Like I said, I will follow up with a link to the recording. Give me a day or two. I will get Michelle on it. And also because I do have that surgery tomorrow, so it might be a little bit more delayed than normal getting online. And also because I do want to put a slide on there that introduces us and has our contact info, but I'll make sure that goes out to you in an email as well. So if you guys have any further questions, you've got my email. If it's a question for Jennifer, what's your email address? Just kind of blurt it out. JTaylor at E3 Wealth.
JTaylor, yep. JTaylor at E3, and it's just the number 3. So E3 Wealth, WEALTH.com.
Yeah.
And so we're we're in the process of updating our website. So forgive us if you get on there and it's not very aesthetically pleasing. We're working on that. We're aware of that. But we are also here in the Austin area, but we also are licensed to work across the entire country. And, what's great about, I guess, the pandemic has been people are so much more willing to do things and more comfortable to do things via Zoom, et cetera.
Yes.
And it's kind of made it easier because
too.
before, people North Austin didn't want to drive south didn't want to drive north. And, that was 40, 45 minutes, let alone, dealing with someone in Dallas and Austin. So we are just like Amy in that what you saw here, the conversational, the education, we are very education focused. Calling, talking with us, seeing if we're a good fit, that will cost you nothing but your time, and time is valuable. I don't have a lot of it to waste. I know that the busy entrepreneurs, business owners, people on this call don't either. And so, we would take that very seriously if you guys did reach out, and do our best to add value, however that looks, whether it's in a tax strategy for this year, or if you want to really go deeper and see how we can help you retire and live on the beach at 50, then hey, give us a call. I'll help you pick the beach spot.
Yeah, I had to push mine back a little ways, but that's okay. I'm good with it.
We'll blame Robert.
That sounds good. All right, everybody. I want to thank everybody for joining us. We held a pretty good retention. Hold on. Oh, prayers for my surgery. I appreciate that. I take them all in all forms and shapes. I do plan on being back Monday, and I will, a little funny side note, the surgeon, he goes, and we could probably do something about that voice. I said, whoa. That's part of me. I like my voice. I'm used to it. I hate hearing it back, but anyways, we'll say I might sound different. It'll probably take 8 or 12 weeks for it all to heal up. But anyways, I appreciate all of you guys. I feel like I have a really strong following, and this is what I love to do. I love to educate. I mean, we'll throw some sales pitches in there, but really the point is to educate. So I'm glad you guys are all here, and I hope you all learned something. And so until next month on the first Wednesday, I'm not sure what the topic is yet, but we'll get that figured out soon. All right. Thank you guys. Bye, Jennifer. Thank you.
Bye. Thank you.